Hello, dear candidates. Thank you very much for joining back. So this is a series of videos for CMA Part 1 MCQs based question and answers. So let's jump into the third video of the day. So the following question is based on the following. Here we have the topic financial reporting, and specifically this question is appearing from the topic income statement. When company's trial balance of income statement account for the year ended 31st December year one included the following. So you can see all the information are given to you. The debits or of the income statement represent the expenses and losses. You just need to recognize the debit side of income statement represent the expenses categories and loss categories. However, on the credit side of the income statement, they represent the revenues and gains. Okay, remember that typical hint of the question. Any debit will be expressing as expense or loss. Any credit goes to revenues or gain category. So sale has been given, cost of sale, administrative expenses, loss on sale of equipment. Technically, this is a continued operation. Sales commission, this is continued operation. Interest revenue, freight outwards, loss on early retirement of long-term debts. Again, this is a loss on continued operations. Uncollectible expenses, technically bad debts. Okay, so we have some other information. Finished goods inventory, the opening inventory and closing inventory is given to you. And the tax rate is also given to you. That's straightforward 30% tax rates. The question is asking you, what is the company's in company year one multiple step income statement? What amount should Wayne report as income from continuing operations? So all the information given to you are income or expenses from continued operations. There is a very single or easy way out to solve this question. If you total the credit side, that's going to be 600,000. If you use your calculator now, 600,000 is your credit. It means revenues and gains minus all the total of debit side, 420,000. So when you equal, this becomes your income from continued operations, 180,000. However, when you tax it 180,000 with 30% tax, what is the final income left with you after paying the tax? So let's calculate 180,000 and 30% is the tax rate. So you can directly multiply with it 70%. So your final answer should be 126,000. If you are not comfortable in solving this question, so 180,000 is your income before tax. Multiply by its 30% tax. So 54,000 is the tax expenses. So you can do 180,000 minus 54,000. Again, the answer is same. So you can do either way. 180,000 times its 70% or 180,000 minus 30% of tax. This gives you the same answer. So let's see, option number B is the correct answer. Let's go for the next question. Levis Industries report the following at the end of the current year. Service revenue, 800,000. Administrative expenses, 240,000. Loss on sale of investment. Okay, interest expenses given, interest income is also given. Cost of service is given. Calculate the operating income. Yes, candidates, you need to be a little bit tricky for this question. They have given you some extra information in this question. And these extra information are technically trapping you in this question. So they're asking you just to calculate the operating income. Where you see loss on sale of investment is other income, not operating income. Interest expense and interest income is a other income and other expenses. So we need to just do one thing using our calculator. So what's first one information is 800,000. So let's sort again. 800,000 is your service revenue. If you use your calculator, minus the cost of services 310,000. This gives you gross profit 490,000 minus any administrative expenses. And then you are done with the operating income. So your correct answer should be 250,000. So if you see options are given to you, so 250,000 is the correct answer. Why not other options are correct? Because they have included the interest income, interest expense, or loss on sale of investment. That's not operating income, that's other income. That comes after operating income. So let's jump into the last question of this video. So we have given information. Company paid cash of 12,000 on August 1st. Remember, the dates are very important in this type of questions. On August 1st, the company has paid in advance 1 year expense. So when you are recording this, you recorded prepaid expense, prepaid rent debit, cash credit. Okay. So you recorded on 1st of August. Prepaid rent to cash. This entry was made on 1st of August 2000, I think so. It's year one. So whatever the years are given. So you can just write year one, 12,000. So according to the matching principle, you need to recognize the expense which belongs to this particular period, year one. On December 31st, what will be your adjusting entry? So according to the concept, prepaid rent should be reduced. How many months we have used the rent? So from August, September, October, November, and December. So we have used this 12,000 prepaid up to 5 months. So we need to reduce the prepaid and we need to increase the expense category. So if I just solve this question here, so we need to recognize the rent expense debit for 5 months, and prepaid will be recorded as credit because the assets are no more available. So we have consumed the prepaid up to 5 months. So 12,000 was paid for 1 year. So it means for 1 month we have paid 1,000. For 5 months, we need to recognize 5,000 expense and decrease of the assets 5,000 on 31st of December, year one. So this should be your entry. Let's see which one is the correct answer. Debit rent expense, credit prepaid. Yes, it is the correct answer. So we don't need to look into any other option because we have solved manually. So correct answer is option A. So keep connected yourself with this channel. I'm gonna upload entire modules and entire sections of CMA part 1 very shortly. So connect yourself with this channel. You will be getting benefit from this channel. Stay blessed. See you next video.